Hey everyone, welcome to WealthScienceX. I'm Tony.
I'm Jamal.
In this week's video, I'm just going to go over some of the trades and the purchases that I picked up this week.
I'm going to go through some of the economic data that came out this week, and also we're going to look at the 10-year yield, where that's headed, and kind of my output on the market in terms of technicals on both the S&P and the NASDAQ. So make sure you're tuned in because there's a lot of big formations going on in the markets, and we want you to kind of have all the information for your trades.
Before we get into the video, make sure you smash the like button, click that bell notification, make sure to follow us on Instagram, LinkedIn, and Facebook.
We also have our podcast on Spotify, so make sure you add us on there. There's a bit of different content that we post on the podcast. It's easier to follow, especially when you're working from home or if you don't have time to watch our YouTube vids.
And without further ado, let's get into the video.
One of the most important economic data that came out this week was the CPI, and the CPI showed a 5% increase for the month of May, which was higher than expectations, and it was the fastest pace of increase since the summer of 2008. And we all know what happened in 2008 afterwards, where we had the economic crash. So this is not a good sign for the market.
If you don't know what the CPI is, it's just the Consumer Price Index. And just to chime in with Jamal's comment, with the economy reopening and COVID restrictions releasing and people getting back to work, we can definitely see that the CPI will definitely increase.
And back to Tony's point, all the money that was printed last year, it's all going to be chasing the same goods. You know, we have a limited amount of goods out there, and now we have so much cash, and all that cash is going to be chasing the normal items that we typically chase. So looking at the 10-year yield and why we like to look at the 10-year yield, we like to look at two items before we make investing decisions. The 10-year yield, which is the TNX, and the Dixie, the dollar index. The 10-year yield, the reason being is anytime the 10-year yield's going up, tech stocks, high growth stocks are going to be going down. And the reason for that is tech stocks are all about growth, and the way they achieve that growth is through access to liquidity from the banks. And if the interest rates are up, they won't be able to get as much funding as they want to. So their growth potential for the future is going to be cut in a way, and valuations for tech companies are going to suffer. And that's why over the last couple months, a lot of the high-flying tech stocks like Zoom, Tesla, they fell 30% when this rally, you can see off the lows, this rally was big. We more than tripled our interest rate in a couple months, which is something that's unheard of for the 10-year yield in such a short time. But at the same time, when the 10-year yield's going up, the banking sector, oil and gas, those sectors typically do well, because the higher interest rates, banks can finance and make more money through higher interest rates than lower interest rates. So it's all cyclical.
And just so you know, so bonds and stocks typically have an inverse relationship. And with Jamal's comment, yeah, the tech stocks do get hit the most.
So looking at the 10-year yield, we're forming somewhat of a bull flag. You can see this bull flag. It's looking real nice, real technical. We've been failing off of this upper resistance line. We've always been coming down, and once we come down to the support line of this flag, we've been finding good bounces. We're also sitting at a nice, reasonable support level.
So just curious, Jamal, I'm not seeing too much like return. So for 10 years of buying the 10-year bond, I'm only getting 1.7% return after 10 years. What type of what type of person would buy this?
Yeah, so Tony, to your point, like people who invest in the 10-year bond, those are typical, like the large retirement hedge funds who are not looking for high growth, but they're looking for sustainable, guaranteed, low risk growth. And most allocations to bonds in those sorts of portfolios are anywhere between 20 to 30%. But the only benefit of this is it's guaranteed, but at such a low yield, it doesn't make sense because over time inflation is going to cut into your, it's going to cut into your profits. And bonds, a lot of people, especially like Kathy Woods and people who believe in the high tech growth, they're short the bond market. And a lot of people say that the bond market is in a bubble itself, and when the bond bubble comes crashing down, we're going to go through a major financial risk. The reason being, like, we're just printing free money. Yields should not be this low if the economy is booming, right? We're always hearing this narrative that the economy is booming. We just looked at the CPI data. Inflation is going up. So it doesn't make any sense with the way our economy is at right now that the yields should be this low. And we can see signs, in the housing market. Housing prices are up 20% in 1 year, which is something unheard of. Even look at used cars, Tony.
Used cars are up. The price of lumber is up. The price of labor has skyrocketed. Everything is just so expensive, and there's a massive labor shortage. So it just keeps driving that cost up.
Yeah, so right now this does not make sense with what the 10-year yield's doing. A lot of people think this movement, this recent downwards movement in 10-year yield is something to be concerned about because this shows fear. This shows that the average and like people who are investing in bonds are kind of fearful of putting their money in the bond market, and they'd rather have their risk on in stocks. Um, right now, I think we should expect a bounce off of the flag formation and this support level. So, I don't think it's a good time for us to start looking at swinging tech stocks just because of where the 10-year yield's at. If we fall below this 14.47 level, then we can start considering, getting back into the high-tech growth stocks like Zoom, Tesla, Peloton, and all those companies. Right now, I think it's not a good time. We should be patient for this because if this moves back up and breaks this flag, then the tech market is going to go through another down cycle. But right now, if this rallies and finds support, then I think the banking sector is going to be good for us to swing, because if this 10-year yield goes up, the banking sector is going to do well. So now that we've gone through the 10-year yield and we kind of know where we're going to be looking at for the next couple weeks, let's look at the major averages, specifically the SPY and the NASDAQ. Looking at the SPY, and we're looking at the 3-year weekly chart. We've been trading in a megaphone pattern, and you can see why it's called a megaphone pattern because it looks like a megaphone where you have higher highs and lower lows forming. We've broken out at this, back in November. December of 2020, we broke out from the megaphone pattern. We've rallied. We've had a strong rally outside of it, and just Friday we hit all-time highs on SPY, and by the looks of it, nothing's gonna stop us. This is a very strong move on the SPY. As a long-term investor, you can see that this move is kind of like not too healthy off of the lows. We really haven't had any major drops in the markets. And as a long-term investor, I don't think the market's healthy for us to start looking at long-term investments. As short-term swing traders, I see a lot of value in SPY just because we broke through the critical resistance at 422. And right now, it's very hard to be negative on the SPY. The reason being, the SPY includes a bunch of sectors. It includes the tech sector, the banking sector, the oil and gas sector. So, as a general market overview, SPY is less affected by the 10-year yield. While the NASDAQ, anytime the 10-year yield goes up, the NASDAQ is the index that gets hit the most. So looking at the SPY, what's gonna make us kind of be more worried is if this turns out to be a false breakout or a bull trap and we rally for a couple days, but then we face like a nasty sell-off and we drop below the 422, then this is any movement above this price point is going to be a bull trap, and we're probably going to retest this megaphone resistance. So we can
Looks like Thor's hammer at the top there.
yeah. So right now you're right, Tony. This looks like Thor's hammer. So we do have some momentum in the market, but what I'm seeing over time is the volume is decreasing. So you can see anytime we're having such a major move like this, but the volume's going down, that's not a good sign. Um, it's something that shows that the rally's kind of fizzling out, and I would not want to be a long-term investor in SPY at this stage. So we can expect, a move like this upwards. I ideally want us to retest this support level. So a move back to 422 and us bouncing back up. I think it's really bullish for the SPY. But if we break this resistance and we come back to the resistance line for the megaphone pattern, this should be our last kind of support. This should give us a good chance of going in. We expect this to bounce. If this level does not bounce, then I think we're gonna go through a major correction, and we might find new lows on the SPY, and we might retest the support of the megaphone pattern, which is something that's going to be very detrimental to the market, because with the megaphone pattern, if this plays out, we're going to go through lower lows than the 2020 market crash. And that's going to be something that not a lot of people are prepared for. So, right now I think we're good. But if we break below this support level, it's going to be a very tough day for the markets. So now let's look at the QQQ. The QQQ has been kind of like on a similar pattern as the SPY. We haven't really been forming a megaphone pattern, but we're in like an upwards channel for the past 3 years. We did break through back in July, the tech sector when the market crashed in 2020. It was the strongest sector just because, everything was going online, a lot of dependence on tech for people to work and just maintain their lives. So tech was a major beneficial of this COVID work from home era. And so since we've moved above this resistance level, the Nasdaq has been strong. We've gone through a couple corrections. This is normal price action. We were kind of fearful in this stage. This is when the 10-year yield started moving really fast to the upside, and the Nasdaq was down 12.6% off the highs. So we can see that there was some fear in the markets, in the tech market. But right now we're forming a pendant, and you can see this support line. We've always been able to find support off of it and trend higher. If we look at the 4-hour, just like if we focus more on the short-term chart, you can see anytime we've come to this support level, we've bounced. Right now, the Nasdaq has been strong. We've gone through some major supply levels, and nothing's stopping us from retesting the all-time high, which is 342.88. So this level is going to be like crucial for us to watch. This whole zone, this whole supply zone, we're right at there. So Friday we just closed a couple points below that demand zone. So Monday is going to be really critical for us to see if we fail and move back lower, or if we can get past supply. And our target is going to be towards the upper level of this resistance, which is anywhere between 346 to 345. So I think these are like sustainable targets for us on the Nasdaq.
Are you going to be shorting QQQ anytime soon, Jamal?
Not now, because I think, Tony, we can still find some movement up to like 346. At this level, I would be interested in shorting just as protection. So this is the move I'm looking for. I expect us to, tap this resistance again and maybe start forming, and then maybe finding some downwards momentum back, and then trying to retest this support a third final time. The way I've seen markets move is a lot of times these movements play out in threes. So we've had one, we've had two, and I'm looking for a third bounce.
Nice.
So at 346, maybe next week, I would open up, just a QQQ put position as insurance. Nothing too big, just something to kind of like fend off my portfolio in case this downwards move happens. And then once this downwards move happens and we can kind of come back to support, I would look into, going into tech and maybe some QQQ calls so we can ride this next move up. Now, if we fail this, I think it's going to get ugly for the market in general. Right now, I'm more bearish on QQQ just because of where the 10-year yield is, and we've kind of walked through it. So if the 10-year yield starts going up from where it's at right now, I expect us to start seeing some weakness in NASDAQ.
And so I just wanted to go through some of the purchases that I picked up this week. I picked up this ETF, CNYA. If you don't know what CNYA is, it is just an ETF that tracks domestic equities that are on the Shanghai and Shenzhen Stock Exchange. My reasoning and logic behind purchasing this ETF, I'm very bullish on China's economy. I'm betting that their economy is just going to keep growing. It's a very rapidly growing economy. One other purchase I did pick up this week, I am acquiring Coinbase. I'm super bullish on cryptocurrency. Being a crypto author and a crypto enthusiast, I am very bullish on Coinbase. Number one reason, they are the first ever and right now the only crypto exchange that has their own stock, and they're on the stock market. So I'm super bullish on Coinbase for the long term. And I picked it up. The IPO price came in above $400, so I kind of waited to purchase it. I did purchase around the 240 mark, and then I also purchased around this $223 mark. I'm just going to keep picking up more. Reason being, it's just cheap and it's a long-term buy. I'm betting on the crypto industry. Coinbase, if you don't know, they've got several different platforms. Coinbase Pro as well, one of their high-level trading softwares. So Coinbase, I really believe, is a good company. They're secure. They're insured by the FDIC. So they're backed up by the government. Another thing I purchased, I did pick up some more SLV. I am bullish on commodities, especially because we are hitting a time of inflation. I really believe that we're going kind of towards inflation, especially as the economy reopens. So looking to put my money in commodities and precious metals, things that don't lose value to inflation. And one of the ways I invest in silver. I own physical silver as well as buying silver ETFs. So I'm a big fan of precious metals and precious commodities just because they tend not to be affected too much by inflation and they retain their value. I did pick up some Ethereum. I'm super bullish on Ethereum. I really believe that Vitalik Buterin, he's a visionary. It's based on a smart contract system, and Ethereum has a lot of other cryptocurrencies tied to it. If you go on Coinbase, you'll notice that a lot of other cryptocurrencies correlate with the price of Ethereum. And I firmly believe that Ethereum eventually will overtake Bitcoin, just for the fact of its usability. All right, everyone, we hope you enjoyed the video. My plan is just to keep doing the dollar cost averaging and pick up shares in cryptocurrency every single month with the disposable income that I can't afford to lose.
And with the charts that we went over, S&P looks like it's going to keep making new highs. The NASDAQ is kind of reaching its resistance, so we want to make sure not to open up any major trades in the next coming weeks. I truly believe the market's going to go through a major correction soon. Just looking at how the crypto market crashed in the last couple weeks, this is a good gauge of consumer sentiment, and we can expect something to happen in the stock market over the next maybe couple weeks or month. So it's still not a bad time to be kind of protective, secure the cash.
Thank you for being part of the WealthScienceX community. Thank you for watching. Thank you for the support. Please feel free to leave a comment. Feel free to reach out to us anytime. We do have a Calendly link. You can schedule some one-on-one time. We'd love to talk.
And with that, we'll see you next Saturday.
See you, everyone.